The Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. That's the investment firm, Wilsey Asset Management. We got a great show lined up for you. Got so many topics to make you a smarter investor. First topic today, we want to talk about there are many headwinds for short-term interest rates to drop in 2026. We'll discuss that and why. The tariffs, well, they seem to be working with the October trade deficit at the lowest level, listen to this, since 2009. Gosh, that's over 16 years, just about 16 years. So, and in the news now is the 10% credit card. Is that a good idea? We'll talk about that. Is a 10% credit card interest cap, is that a good idea? We'll discuss it and talk about good or bad. Chase, what do we got for companies?
So companies we're going to look at, Constellation Brands. You may recognize, of course, Corona, Modelo. That's really where they kind of focus. They have other liquor as well within their portfolio. I'm going to say they're a diversified alcohol company. Also, we're going to look at Walmart, Expedia, and Boeing. As always, we're going to break down the fundamentals, give you an idea of what we see when it comes to the valuations, the balance sheet, profit levels, and ultimately, if we think it's a buy, sell, or hold based off the numbers we see.
Great companies we picked this week. A lot of news going on with those companies.
Yeah, a lot of news going on. So excited to kind of look and see if there's any potential there.
So stay tuned for that. But first, I'm going to talk off the tariffs seem to be working with the October trade deficit at the lowest level since 2009. I was so happy and excited when I saw this. The October trade deficit was only $29.4 billion. I remember it being sometimes triple digits, over $100 billion, which is far better than the expected deficit of $58.4 billion. Not only was it almost half the expected amount, but it was also the lowest deficit going back 16 years to 2009. The low trade deficit was due to imports falling to $331.4 billion, but the other thing was exports also increased to $302 billion.
And when you look at the exports, there was some accounting essentially that kind of boosted that number. Exports did benefit from the high price of gold, silver, and other metals, and it's estimated that increased exports by about $10 billion during October. The big benefit on the reduction of imports, well, that came from pharmaceuticals dropping sharply, probably because in late September, the administration threatened 100% tariffs on overseas pharmaceuticals, and the drug makers were apparently scrambling on what to do and trying to minimize the impact going forward. Obviously, doubling the cost on that would be maybe not the most ideal business situation.
No. And I've racked my brain trying to figure out, how do the metals, gold and silver, I guess maybe they're bought from us, but how did it increase by $10 billion? Is that going to happen again every time that gold and silver go up? That's my only thought was that because
Silver's been crazy, and silver is actually used in industrial purposes. So I'd be curious if there was more of a breakdown between silver and gold, and really where that $10 billion came from. If I had to hypothesize, I'd almost lean more that it was silver because there's more of a use case. And of course, silver's price, it's been
it's about 90.
It's been like crypto. It's just been up and down and all over the place. And I don't think, as you said, I don't think that's going to be there every single month, though.
Yeah.
So, that is one thing that may have artificially lifted that trade deficit and made the numbers look a little bit better than anticipated.
And actually, because the trade deficit comes out like about 2 months later, this is October. I think in November, silver was still rising. Here it is, January still rising. So we could get a little push on that for a couple months to come yet. We'll see.
Yeah.
Well, the Supreme Court will not make the decision on whether the tariffs are legal or not just because, they seem to be working. They will determine if the use of the International Emergency Economic Powers Act to impose tariffs is legal or not. Now, my hope is that they do agree with it, and if not, hopefully the administration can come up with some other way of keeping the tariffs intact, as they seem to be working very well. We like that low trade deficit.
Yeah, a low trade deficit is beneficial to GDP because obviously you look at your net import-export number, and the better that trade balance is, it helps with GDP's numbers. And you think about it as well conceptually. Obviously, if you're producing more and shipping it out and then importing less, that should help with the jobs picture because it gives people more work to do. So, I mean, there's going to be positive to it. I do believe, of course, that the trade is, still important to have a good relationship with other countries and so forth. I just think it got so out of whack for so many years.
Yeah, and the thing I've never liked about the deficit, it got so large that we're sending this money out to other countries, getting nothing back but consumable goods, which are gone pretty quick. And I remember back in economics, the guns and the butter rule, where if you're good at making guns, you make guns, you're good at making butter, you make butter, and you have a trade. What happened was we were buying so much more from everybody else, and they weren't buying our products. We were just sending money overseas to all these countries, and eventually you run into where like, hey, we got nothing left. That's why we got such a big debt deficit.
Yeah, and the thing that I am going to be curious on going forward, I mean, you brought up that big kind of differential in the trade deficit compared to what we had seen in the past. I mean, obviously these tariffs were enacted early last year, in April is kind of when the announcement took place. And if you recall, there was a huge trade deficit for the first couple of months because companies were trying to front load that. How much more, we've talked about this for months, it seems like, but how much more inventory can they really be working through? I think we're going to finally start to get maybe more normalized trade data, maybe in March, April, and then I think we'll really see where things are at because by then, I'd have to assume the companies would have burned through that inventory that was so heavily front-loaded. And the trade deficit that you pointed out, I don't know if that's going to be a bottom or maybe a more normalized level, but there will be a point where I don't think the trade deficit is going to get better because, again, then companies will need to start buying more overseas once they burn through that inventory.
Yeah, and I doubt we'd have a trade surplus. I mean, who knows? I suppose that could happen. But it's just, I remember seeing, a couple of years ago, looking at the deficit. Gosh, we spent $70 billion in 1 month, different country. Like, wow, this is just crazy. I mean, it's not a good thing. So I'm happy to see we seem to be going the right direction. I hope to stay in that course, but we'll watch it for people month by month, see what happens. Let's talk about there are many headwinds for short-term interest rates to drop in 2026. Everybody's like, oh, this is going to be great because there's going to be a new Fed chair in there. Oh, rates are going to drop. Well, don't be so quick to think that because it's no secret that the president, yes, he wants our interest rates to drop dramatically to improve the economy, which, as a side note, our economy I don't think is really that bad. However, even though he gets to appoint a new Federal Reserve chairman, that does not guarantee lower short-term interest rates. The Federal Reserve chairman term, it does end May 15th, which means a new chairman will be appointed by the president. But the chairman running the Federal Reserve, no matter who they are, does not make the sole decision on the direction of interest rates.
Yeah, and it is interesting. We did see this past week, betting markets now have a pretty heavy hand towards, his name is Kevin Warsh. Kevin Hassett was the kind of favorite.
Right.
Him and Warsh were kind of going back, almost kind of 50-50. But at an event, I guess Trump came out and said, Kevin Hassett, kind of confusing them both, named Kevin, I want to keep you where you are, essentially. So it looks like Warsh is favored to get that job, and we could be seeing an announcement here soon.
And I'm sure Trump's not going to appoint somebody that's going to raise rates, so this Warsh, he probably still will want to be.
I mean, they did interviews with Scott Bessent one-on-one, right. So I mean, I think it's unlikely that he's what we'll call a hawk in wanting to increase rates. Yeah. So we'll take a look here. But to kind of look again at how the interest rate increases or decreases do occur, it is done as a vote from all members, and it takes a majority of 7 members to move interest rates, again, up or down. Other factors, too, to consider is Mr. Powell can stay until January 2028. Even though his appointment as Fed chair ends, his appointment as a governor does not expire until, again, January 2028. This does mean a new governor who is in favor of reducing interest rates cannot be appointed until January 2028 unless he leaves. I don't know what he's going to do. I mean, is he just like, I'm done with this? And he might bow out. So it will be interesting to see, I guess, what he does. And I don't know what precedent is. In the past, have Fed chairs that were governors and still had a term left as governor, did they bow out or did they stay on? That's something that may be of interest.
I mean, they don't change that much, and I just can't even remember, like Bernanke and these other, I don't know. Like,
I almost feel like they leave because I think it's, like you point out Bernanke, you talk about Janet Yellen. I can't remember them being on the Fed after their term ended, and maybe they just coincided with one another.
Yeah, and it could be too like, well, I was the president of it. No, I don't want to just be a normal member. So maybe the ego says, no, I'm going to leave. But well, in spite, he might say, no, I'm going to stay.
Yeah, especially it doesn't seem like him and Trump get along too well now.
Really? Didn't notice that one.
The other thing, too, to point out is that there will also be changes to other members come January 31st when some other members' terms do expire. This will be another opportunity to appoint members that are aggressive on reducing interest rates. So, again, there's going to be this balance between who's coming, who's going, and what's the new Fed. I say new Fed, but of course there are so many changes. But what is the Fed this year going to really look like?
Yep. And also, sometime this month, and this was kind of a surprise, the Supreme Court will rule on removing or keeping Fed Governor Lisa Cook over legal issues. Now, if she is removed, that's another opportunity to bring in someone aggressive on lowering rates. At the January meeting, there will be a rotation for the voting regional bank presidents, which include New York, Cleveland, Philadelphia, Dallas, and Minneapolis. Now, some of these new voting bank presidents have explained their concerns when it comes to lowering rates, especially with the inflation target. They're saying, well, it's still 2%. We've not achieved that, it seems like, forever.
Yeah, I know. It's definitely been off there. I mean, when you look at that 2% inflation target, that was set back in 2012, and it's been above that level since March 2021. So it's been some time now. All this to say the direction of interest rates, it's definitely uncertain. If we were to see unemployment rise and more signs of a slowing in the economy, we probably would see more interest rate cuts. However, if things stay the status quo, I still believe most likely we'll see 2 interest rate cuts in 2026. But again, there's a lot of uncertainty with who's coming, who's going, who is going to get appointed on that board. And I mean, also Michelle Bowman, I know she came out. She said, I think there could be more interest rate cuts. I do know you talked about the new people that are rotating in. Several of them seem to be more kind of hawkish.
Yeah.
Maybe not hawkish, not dovish, but they don't seem to be in favor of cutting rates, as you said.
They seem to be more in favor of the fight on inflation, and we're not near 2% inflation. I think you said 2020, so we're going on, 5-6 years of not hitting that target.
Yeah.
Is it really a target if you never hit it? So I think they're more concerned about the inflation, especially with our economy is not bad. And I know that the GDP for the fourth quarter was like 3.9 or something. Remember,
It was quite strong.
Yeah, quite strong. So I just don't see, and if we were to cut rates more, short-term rates, and I think they cover about $15 trillion in short-term money, we can actually have heated inflation. Too much money chasing too few goods. So that could be a problem, having too much inflation because they cut rates.
Yeah, and I did want to clear something up for people. I mean, the Fed is just so complicated. We pulled this last week. We didn't throw it in the post, but I want to make sure we kind of pointed out how the Fed operates. There's 19 FOMC members, and 12 of them cast votes. So that's where that 7 majority that I talked about comes in. And the way it works is there's 7 board of governors. They're permanent voters. There's 1 New York Fed president. Right now, I think his name is John Williams. He's also a permanent voter. And there's regional Fed presidents, again, the 11 remaining regional Fed presidents, and only 4 of them vote, but again, on that rotating basis. So it's a little bit complicated, but that's, again, a little bit of an overview of how the voting system works for the Federal Reserve.
And we discussed that because I think it helps people understand how complicated it is. It's not like, oh, the Fed chairman does this, he's definitely going to lower rates. There's so much behind it. The rotating members, the majority. That's why we talk about this stuff, because it helps us make our decisions investment-wise. And I think for people as well, understanding this, it hopefully helps them make better decisions as well.
Yeah, I think so. And one thing I wanted to circle back to is this whole inflation thing. I was looking at this, because inflation did come out this last week. I think it was, 2.7 on the headline, and I think it was actually 2.6 on the core. So, we are getting closer to that 2% target, but the big one that I keep looking at, and we've talked about this, is shelter. And actually, shelter is now kind of pushing towards the mid-3s.
Yeah.
And I was looking back at this. I had ChatGPT pull it for me. At one point in 2023, we had several months in a row where we were at or right near 8% inflation on that shelter index. And it's just so important because it is the largest weight. I think I want to say it's around 40-ish% of the core CPI. So again, that's what the Fed is targeting as core prices, but it's so heavily tilted towards shelter that if we continue to see shelter go down, very possible we see shelter maybe at 1% as we exit this year. That could be a huge weight to the downside on inflation, and we could actually push towards that 2% target. I think it was artificially lifted because of shelter, and now it could be artificially low because of shelter.
And one thing inflation does too, it works on your consumer confidence. And one thing too, I still hear from people, oh, inflation's not coming down. I go to the grocery store. That's what it hits them the most. And also the gas pump. Now the gas pump things have come down, especially across the country. So that's a positive. But the people still say, no, we still have inflation because every week or every 2 weeks they go to the grocery store and they just see like, gee, you know, the price of meat was, I don't do the shopping in my house, but $4 a pound. Now it's up $5 a pound. So that's in their head. That can hurt their confidence when it comes to other spending.
Well, and the big problem that people have is not understanding the difference between price level and inflation. They look at, as you say, oh, my grocery prices are still expensive. I hate to break the news to you, but prices aren't coming down.
Right.
That is not healthy for the economy. Deflation can actually be a very dangerous thing for the economy. So don't look at saying, and of course, little things can happen, right? Like egg prices, they went way up.
Yeah.
Now those are coming down. So you can have singular items that are going to go up and down. But as a whole, inflation and price levels, they are going to adjust and should adjust incrementally each year. We shouldn't have runaway inflation of 5% a year, but also you're not going to have price deflation of 2% a year.
That destroys the economy.
Oh, yeah.
Yep. So in the news is the 10% credit card interest rate cap. Is that a good idea? Well, at first glance, the average person is going to say, I almost swore on that one. I'll just say, yes. That is great because current credit card rates are around 23 to 24%, which I got to say they are kind of ridiculous sounding. However, when you dig deeper into credit cards and how they work, people have to realize the risk for defaults and the late payments, well, they're rather high.
Yeah, and the thing you have to understand is that banks that issue credit cards, well, I hate to say it, but they are in business to make a profit for their shareholders. They're not a charity that is just giving handout of free money. And if there's no profit to be earned, well, then there's no point in a business offering that service. And when you look at this, the current default rate on credit cards is about 3%, which means banks have to write off that entire balance of whatever that person owed. And we look at it kind of statistically, the higher default rates are unfortunately seen in zip codes with lower incomes and also for younger borrowers who got in over their heads. They didn't understand how credit works. And we talk about this. Unfortunately, there's not much financial education.
Yeah.
I don't know how you fix that, frankly. To me, it's like you got to learn how to budget and be on track. But unfortunately, people get in over their heads and it causes these issues. And if, again, they're defaulting on that, that is just lost money to the bank.
Don't they now in high school? I think you had a little bit. Like, didn't they do like a consumer class or something in high school? Or is that...
No, we did economics, but
Economics.
there was never really anything personal finance. Like, you don't know what a standard deduction is. I bet you most people across the country don't know what a standard deduction is when you file your taxes.
Yeah, Sarah and some of them shaking her head. No, I don't know what that is. Yeah, so and it is kind of a shame, and I don't know how you even get that education because it's just. And I've heard of people saying, "Well, I didn't know there was interest on a credit card. I just thought, you know, I just put on the card and." I don't know where they think it came from, but there is lacking financial education in our country. And I guess it should come from parents, but if the parents don't know, they can't pass on down to the children either. So, but if the 10% cap on credit cards goes through, it will hurt people with lower incomes and those that have lower credit scores because banks, well, would no longer be able to be profitable on those accounts and they would stop offering credit to those people. That's what they have to do. It would also affect many across the board as you could see a reduction, if not elimination, of points and cash rewards on credit cards, which, well, that'd be very disappointing for many. I mean, we talk about, pay your card off every month, collect those rewards, collect those cash rewards. That could go by the wayside because banks say, well, we just can't make any money off credit cards.
Yeah, I know. And they're a great tool. You just got to know how to use the tool properly. And that's kind of why, in my opinion, it's better to have the higher interest rate on credit cards like we have today as it broadens the pool of people, again, that can access that particular tool. But unfortunately, people need to use some self-discipline to not get in over their head and make sure they can pay their payments and hopefully not carry a balance on the card. If they can do that, they pay no interest and also can benefit from cash back and other reward programs. And people think I'm crazy. I always tell people the APR, when you're looking at a credit card, it should have no bearing on your decision if you should go with that card or another one. It's like, oh, that one's 23%. I can get one for 10%. It shouldn't matter because still, to me, 10% is not a good rate for the average person to borrow at. What really comes down to is what offers the best rewards, because if you're tapping credit card interest, that's just not a good financial strategy, no matter what the APR is. That sounds crazy. If the APR was 50% on a credit card, I still take it because I would never use that carryover of the interest.
Yeah, it'd be great if they said, okay, the APR is 50%, but we'll give you 3% cash reward. I'd take that in a heartbeat, because I'll never carry. I can't remember the last time I carried a bounce on my card. And sometimes, I'm doing very well now. But when I was younger, there's times like, gosh, hard to pay that off at the end of the month, but I got to do it because I did not want to pay that credit interest they're going to charge. And also, too, many times you get down that rabbit hole, it gets worse and worse. So you've got to control your credit. You've got to be disciplined. We talked about, too, on the banks, and we discussed that the total credit cards right now about $1.2 trillion. Now, if you start doing the math on that, saying, okay, that's a lot of credit card debt. If the delinquency rate is 3%.
Default rate, right?
Default rate.
Yeah.
Oh, I'm sorry, default rate, correct. Default rate. You're talking about $36 billion that has to be written off every year. Now, that's between all the banks and so forth, but that's a big problem. And also, too, don't forget that it's not just free money for the banks. They got to do their advertising. They got the buildings that you go into to open it up. They got services with labor. You got that credit card. You want to call somebody, hey, what's going on? I do that all the time, my credit card company. Cost of the funds. The money doesn't fall from the air. They've got to take that money and loan it out to you. So they got to borrow the money. They got to come up with the money. They got to pay interest to the depositors, whatever it may be.
Don't forget about fraud protection as well.
Oh,
I mean, they protect against that. Or I'm sure you've had this happen where I've had a fraudulent charge. The credit card company pays that for you.
Good point. Yeah.
I mean, that's a cost to them as well.
Yeah.
So, I mean, you could lose. It's like, fine, we're not going to be able to charge interest. Well, we're not going to cover fraudulent expenses anymore.
Yeah, now it's your fault. Like, what? I didn't do it.
I didn't do anything.
And then also, too, remember, credit cards have no collateral. So that means, like, if you have a car loan, well, at least then take the car and get something back. Credit cards, and I come and take, I ate at, Ruth Chris last night, so well, give us your meal back, I mean, you can't do that. So that's why, we understand it. I want people to understand, too, yeah, the 10% sounds great to the uninformed. When you think about it, it could wipe out all credit cards to where, like, banks, and again, you kind of apologize. I'm sorry that they need to be profitable, but that's what's made our country, is businesses being profitable and hiring people and paying dividends and investing. I mean, it's just the way our society works, and can't be a charity because it'd be a socialist, communistic economy.
Yeah, and it could hurt things long term. Obviously, credit cards are great for many, and unfortunately, it creates learning and think experiences for some people. But if you can learn how to utilize it properly, again, long term, it's a great benefit to you. But again, there is that, I think, learning that needs to occur for some.
It's like a knife. A knife can be very sharp and cut your meat, or you cut yourself, it hurts. So you got to know how to operate that knife and the credit. So all this information does come from our newsletter. It goes out every Friday at 5 o'clock. It is free. Goes out by email. Other topics there would be a small invention that changed the driving world. You got to read that one. It's incredible. You won't believe it. J.P. Morgan Asset Management is increasing the use of AI. Inflation report comes in positive. Lower EV sales continue to hurt car makers in the U.S. You may soon see drones zigzagging across our skies here in our country. And then LinkedIn's secret to remaining in third place in social media. What's that about? Well, you got to read that one. That one's good as well. All this information free at our website. Sign up for the newsletter. It goes out every Friday at 5 o'clock. SmartInvesting2000.com. Again, that's SmartInvesting2000.com. All right, ready to do a company?
Let's get into it.
Let's talk about Constellation Brands. We ready for that one?
Yeah.
Okay. Constellation Brands, their symbol is STZ. I don't know where they got that symbol from. They're in the beverage brewer industry. Short on the stock is starting to climb. It's 5.5%. Institutional owned is 77%. They do have a PE ratio of 24.6, a little bit high, but not as high as the industry at 30.1. We do see price of sales 3 versus 1.4. Price to book value also high, 3.5 versus 1.8. Price of cash flow 10.3 versus 8.2. And you want these valuation ratios lower than the industry average. And the PEG ratio does look good, though. That's 3.8 versus 21.9. Now, the earnings over the last year for Constellation Brands was up 69.9%. The industry was down 40.2%. I really want to know how that happened. Maybe it was really bad the previous year. Something's going on that's crazy compared to the industry. Sales, however, were down 7.9%, while the industry was up 6.1%. That, again, tells me earnings probably had some type of accounting movement to give you that 69% growth. 5-year growth rate for Constellation Brands, 6.9 versus 5. We do see that they pay a 2.6% dividend, which is not too bad. They use about 64% of their earnings to pay that dividend out. Look at the balance sheet, current ratio 1.3 versus 0.9. That's good. Shows a lot of liquidity for the company. However, debt to equity getting a little bit scary here at 1.4 versus 0.9. 1.4 is probably the top level. We'd even look at investing in a company, get much above that. It gets me worried. They do have a nice profit margin, about 11.8% versus 4.9. Return on equity, 14.4. That is good. We do see free cash flow of $1.7 billion, about half the industry at $3.8 billion. Chase, what do you got?
Yeah, so current price here for Constellation Brands, well, it is $156.64. 52-week range, the low $126.45 and the high $196.91. Year to date, gosh, just in a couple weeks here, it's up 13%. So
Wow.
People must have sold it last year and then maybe trying to buy it back, or maybe hoping for something different. I mean, over the last 5 years, the stock has not been pretty, down about 29%, and the 10-year return here, not including the dividend, well, that is about 5%. So it has not been a winner, to say the least. Now, looking forward for Constellation Brands, again, their ticker symbol, STZ, we go out to February 2027, so we might actually be pushing forward here another year in about a month and a half to 2 months, maybe. Oh,
Yeah.
actually, no, they just
Probably more.
reported earnings, so we're probably looking at 3 months since they just reported last week. So we're probably talking about 3 months until we'd push forward another year. But anyways, I look at February 2027, estimated earnings per share here, $12.36. It gives us a target sell price of $205.18. The stock trades at, around 12.5, 13 times future earnings, which is right in the value category we'd consider.
Yeah, so it could be a buy. I did hear that Modelo is their Mexican beer. I think they have.
Oh,
correct?
they corner the market on the Mexican lager. They have Modelo, Corona, and Pacifico.
Oh, they have
it looks
Corona.
like.
I didn't know that Corona, but
Pacifico too.
oh, Pacifico too. Okay,
Yeah.
because I know I read that could be a problem because of the deportation. A lot of them don't get together for drinking and socializing, so the beer sales are down in those areas because it's just. And I've had Pacifica. It's okay. I still like my Coors Light. Is what I still like. But I mean, as far as socializing for that population, it seems to be slowing down.
Yeah, I'd be curious on the breakdown of it. I mean, that's really their beer portfolio. Then they also have wine. They have like Kim Crawford. It looks like Robert Mondavi. They also have the Prisoner Wine Company, and then they do have some spirits under Casa Noble. And then Svedka. There's some other ones I don't really recognize, but they again are more of a diversified alcohol company like Molson Coors. They're really in the beer space. They do have other types of alcohol in their portfolio.
Yeah, and I heard wine sales are slowing down too.
And don't forget, Berkshire does have over, I think, a $2 billion stake in this company.
Oh, wow. Okay. Well, there's the music. We're going to wrap up the first half of the show. When we come back, we'll talk about Walmart, Expedia, and Boeing. Stay with us. You're listening to the Smart Investing Show with Brent and Chase Wilsey. We'll be right back. All righty. Welcome back to the second half of the Smart Investing Show. We're not going to talk about Walmart, Expedia, and Boeing yet because now it's a financial planning segment. We talk to our CFP, Harrison Johnson. Harrison, thanks for being here today.
Always. And
we're talking about today, and I've talked about this. I'm glad you're going to dive down deeper into this. Who benefits from the new auto loan interest deduction? Let's talk about that.
Yeah, so this is, I guess, about 6 months old or so. As part of the package last July, where up to $10,000 of annual interest from auto loans can now be deductible. So I think there's some pros and cons to this, to the way that it's put together. But one of the things is it's only available for tax years 25 through 28. So it's only these 4 tax years. A lot of the other things in that tax bill are that as well, only these 4 tax years. This is an above-the-line deduction, so that means if you claim the standard deduction or whether you itemize, you can still get this benefit. So it's an above-the-line deduction. Everyone can claim it. It has to be a new vehicle, so used vehicles don't qualify. That vehicle had to have final assembly in the U.S., and that vehicle had to be purchased from 2025 through 2028. So if you bought a new car, but in 2024 and you still have an auto loan, that interest doesn't qualify. It's only new vehicles purchased 25 through 28. Leases don't count. The loan that you use to buy the car has to be an auto loan, so you can't use like a HELOC or a personal loan or anything. It has to be an actual auto loan. And then there's some income phase outs. So if you're single, you can claim this benefit if your income is under 100,000. As your income goes from 100 up to 150, it starts to phase out. And then if you're married, the phase out is from 200 to 250. So those are those income ranges. This is a federal deduction. Most states do not conform to this, but it looks like California is working on a potential bill that would allow this to be deducted on the state side as well.
What?
Yeah, it's
California's
called
going to do it. What? I can't believe that one.
California AB 490. It's not law yet, but it's a proposal that would allow this interest to be deducted on the state side as well.
There's probably one Republican that's in that. Yeah. Right up, so it may not pass. But I like this idea. I think it's a pretty good idea. The thing I don't understand is like final assembly. I mean, how much does that be? Because you could get, I guess, a Toyota, because they make Toyotas, I think, in South Carolina or someplace. Would that qualify, or is it only American brands?
According to what I'm reading here, it's new vehicles with final assembly in the U.S. So that potentially could be a Toyota if it's finishes its manufacturing in the United States. And when you buy a car, somewhere in the documentation it'll tell you where it was put together, so you can know if that qualifies. But
and to me, final assembly could be, well, we put the 4 wheels on, so that was final assembly. I'm sure there's things to prevent that, so it's kind of nice that they have to show you what it actually is. And I guess the dealers will have to show you, yes, this qualifies, or no, it does not.
Yeah. I just bought a car, and they didn't mention this, so
you just bought a car?
Yeah.
Holy crap! I can't believe that.
My car's 12 years old, and it's got a lot of miles on it. So it was about time. It is an American car, but yeah, they
didn't mention it.
They didn't mention that. No.
Well, I mean, the thing is, I think there's some positives to it, but also when you realistically break it down, I think it is such a small subset of the population that will be impacted by it. There are so many different stipulations to it, and the amount of people that are actually going to maximize that $10,000 interest limit, I think, is very low. I think you said the income limitations are 100 and 200. Well, that would just kind of simplistically, that means you'd have to buy a $100,000 car with a 10% interest rate, just very easy on the numbers, to get that 10%,
right,
or $10,000 interest level. So most people aren't going to be at that top level. And the other thing is that the cap would probably put most people at a peak in the 22%.
22, yeah.
Federal tax
so I was going to bring that up because you're right. The $10,000 to me seems almost irrelevant because most auto loans don't have that much annual interest in a year. A $50,000 loan at 5% is $2,500. Yeah. So the other thing is, if you do qualify and you can claim it and your income is within the limits and everything, you're either going to be in the 10, 12, or 22% tax bracket. So depending on how big this auto loan is, your actual tax savings is going to be on the low side, maybe $100. On the higher side, maybe $1,000. So that's kind of the range of, the benefit that'll come along here.
And I think it does help. I mean, we're kind of spoiled here in California. Everybody makes high incomes and so forth. But it's not that way in Arkansas, Alabama, and Kansas and stuff like that. So there's others that will benefit.
I could see there be more people throughout the country that will benefit from this, because if, as a married couple, your income can be up to $200, that's a modified adjusted gross income. So that's like your total income. The standard deduction this year is $32,000, $33,000 or so. So that means your taxable income can be close to $170,000. And you still can qualify for this. And the 22% tax bracket starts at about taxable income of $100,000. So 170 is pretty far in that 22% tax bracket. So yeah, there are people that definitely will benefit from this.
I think the thing that I would look at for the average person is this tax benefit is not so far and above that you should feel very comfortable going out and stretching your means to buy this new vehicle, because again, great, maybe you save $100 to $1,000 in tax benefits. It's not going to help you out as much as you might think. You have to be careful and not be like, oh, I'm going to get the new vehicle rather than a used vehicle, and that could actually hurt you long terms in terms of your out-of-pocket costs. And I know the reason they're doing this is trying to incentivize U.S. manufacturing and, of course, create jobs, which I think is a good intention. But in practice, how much flow-through are we going to see is going to be the big question.
Yeah, well, we'll see. And I mean, it's different than a mortgage, for example. With a mortgage, you get the federal and the state deduction, which in California, since state marginal tax rates are so high, the after-tax interest rate on a mortgage is going to be less than what you would see on a car loan. Also, mortgage rates in many cases, sometimes are a little bit lower than auto loans, depending on who's financing it. Sometimes the manufacturers will have low interest rate financing, like 1% or 2%. That's very low, and in that case, it almost doesn't really do much if the interest rate's that low. But there is some benefit, but it's you have to qualify for it. It's not all vehicles, so just because you have an auto loan doesn't mean it's deductible. It's got to be purchased at the right time, the right type of car, the right type of loan. Final assembly in the U.S., you have to be within those ranges. So if you are looking at buying a car, this is something to be aware of. A, is the car you're looking at going to qualify? And then B, what is the real tax benefit that you're going to get from it?
And also make sure if you did buy a car last year, your CPA is aware of that, just in case you can qualify for that.
And I have nothing back this up. I don't know if you have an opinion, but my guess is it will benefit across the country maybe 30 to 50% of the people. What is your guess?
Well, 30 to 50% of car buyers, maybe.
Yeah, that can use this, yeah.
Yeah, I mean, because if you don't buy a car, obviously this doesn't help you.
That's an important part. Yeah.
So of the total number of people, because not everybody is buying cars all the time, maybe smaller, but of people who are buying cars, I don't know of people who buy cars, how many of those cars are new versus used. That'd be something that's changed. It's got to be a new car.
I think last year there was like 15 million cars sold in the U.S. New cars.
New cars? Okay, so 15 is actually a pretty decent number. So there's about 330 million people or so, 350 or so. So yeah, I mean,
so maybe 7 million people will benefit.
Yeah, that's a lot. That's
pretty good.
Amount.
Yeah, it can help out. So well, good. Well, Harrison, thank you very much. We appreciate it, and we'll talk to you more next week.
Thanks, guys.
All right. Again, that's Harrison Johnson. He is our CFP. If you want a free consultation with him, he is a fee-based planner. He does not try to sell you annuities, insurance. You can sit down with him, talk to him about your financial plan, your taxes, your cash flow, all these important things that you have no idea about. You want somebody to help you plan out your financial future. Give him a call at the office, 858-224-0004. Again, that's 858-224-0004, or go to the website smartinvesting2000.com. Again, that's smartinvesting2000.com, and send them an email. You can come up that way. So, all right, we ready to do another company? I'm looking at Walmart. What do you think here?
Yeah, it's let's look at Walmart.
Walmart's changed over the years, that's for darn sure. So Walmart, their symbol is WMT. They are still in the industry of discount stores. While the float is very low, 0.7%. This is surprising. Institutional ownership is only 37%. That means over 60% is held by individuals. That's a pretty high number.
I'd have to assume the Walton family is a large percentage of that.
Good point. Yep. We do see that the PE ratio is very high, 42, but the industry is also high at 38.4. Price to sales 1.4 versus 1.3. Price to book value 14.2 for Walmart, but it's 41.6 for the industry, so that is a positive. And then price to cash flow is 23.5 for Walmart versus 21% for the industry. No PEG ratio. I'm not sure why, but no PEG ratio for Walmart. We do see the earnings over last year for Walmart have climbed by 18.2%. The industry is only up 1.4%. Sales climbed by 4.3%. That's exactly half the industry at 8.6%. And the 5-year growth rate for Walmart, not looking good. It's a negative 2.6% when the industry is positive 2.7%. I know we're going to look more at the numbers, but I do kind of worry, is Walmart way overpriced, especially if the earnings are not going to climb. That's not a good sign. Wow, the yield on the dividend used to be a decent dividend, but because of the huge run-up in the stock, it's only a 0.8% yield. That's terrible, but the industry is now 0.9%. They do use 32% of their earnings to pay out that low dividend. Look at the balance sheet. We got a current ratio of 0.8 versus 0.9. Yeah, that's okay. Debt to equity, 0.7 versus 0.8. Again, that's okay. We do see a net profit margin of 3.3 versus 3.1. These discount retailers have a lot of turnover. That is why the net profit margin is so low. They do a lot of quantity. Return on equity, and that's why you look at return on equity, because it is 23.8, and we like anything above 15. Return on investment capital, 15.6. The free cash flow for Walmart's very good, $15.2 billion per year. That's well above the industry at $11.4 billion. So that's a good number, but it comes down to what are we paying here and what's the future look like? What do you got, Chase?
Yeah, so current price here for Walmart, again, their ticker symbol WMT, it's $119.70, 52-week range. The low here, $79.81, and the high, $121.24. And I was curious about this, but it's almost there. It's almost at $1 trillion market cap. Current market cap is $950 billion. I mean, the stock it's just done really, really well. I mean, year to date up 7%. Over the last 5 years, it's up 150%. The 1 year return even, up 31%. And the last 10 years, it is up 472%. Probably with that dividend, I'm guessing you are up over 500%.
584.
Yes.
Yep.
So very, very good return there for Walmart over the years. Looking forward, though, this is kind of, again, the big concern with Walmart. You go out to January 2027, estimated earnings per share, $2.97. It gives you a target sell price, almost laughable, $49.30. The forward PE on this company is now over 40 times.
It is laughable.
Yeah.
I mean, gosh.
40 times is what you're paying for the future earnings. This is the tech company Walmart, I guess.
Yeah.
I mean, this is not Walmart. I mean, I know, when I was younger, you had Walmart in the portfolio, and you buy it for 10, 11, 12 times earnings, not 40.
Right. Yeah, it's just a kind of crazy number. I mean, those earnings are pretty tight, but I mean, Walmart has they've done more now with the online business, and they're looking more like an Amazon. So that's why the stock has gone up so much. We did do a post. I don't think we did it yet. I think it'll be their next.
We did the post last week. Yeah.
Okay, on their drone delivery, which can be done in 30 minutes. And I wrote in the post, and I was like, do I need anything from Walmart in 30 minutes? I don't think so.
And I was blown away by the numbers on this. I mean, they are partnering with Wing, which is owned by Alphabet, and they had some drone delivery in place that impact about 2 million customers. Well, now with the expansion, that's going to impact about 40 million Walmart shoppers.
Right.
So, I mean, that's a good amount of people shopping at Walmart that can now use the drone option. And, he raised the point. It's like, gosh, what's going to be going on in our skies? I mean, that's a lot of packages going back and forth. And how big are these packages they're going to be carrying? I mean, can they carry dog food? How big are we talking?
Well, I don't think they can, because I remember the drones, they said they're about 2 to 5 feet long. They go about 65 miles an hour. They hover, I think they said around 65. I don't have the information in front of me. Maybe you have it. Around 65 to 100.
23 feet in the air.
Well,
it will be lowering packages.
That's where they'll. Yeah. But I think when they're traveling above, you can still see them. I think they're still in the line of sight. But yeah, I mean, it's not just Walmart. What about Amazon? I know they're trying to work on this. DoorDash. You've got Target. You've got. Is this going to be in the future where everybody's doing this? I mean, you're going to have drones that are constantly like bees flying around.
And as I said, I'd just be so curious. I mean, I brought up the dog food because I just ordered dog food from Amazon, and I'm like, that's a big box. And I'm like, how could something that weighs 2 to 5 pounds go 65 miles an hour with this big box of dog food? I just can't imagine that's going to work out. How much can these drones really carry?
Well, and here's the thing, too, because for Walmart Plus customers, I guess it's $19.99 a month, you get free drone delivery. So I guess what you could do is, like, every week, like, okay, give me 10 pounds, and you can do it. And that, I think, is a negative because these are not flying for free, and neither Wing nor Walmart would release the actual cost of doing it. But I think it could be so popular that it actually breaks the bank, so to speak, because, like, I don't need to get the 40-pound bag anymore. Just send me a 10-pound bag. Now, my question is, they drop it from 23 feet. I don't think they'd be precise where to drop it. Well, if they drop it in the yard and you got a dog, he sees it, he's going to go eat all the food.
Yeah. You got dog food all over your backyard. Yeah.
So, but it's a very interesting thing with Walmart. I would obviously not buy it at these prices. Congratulations on doing so well with it. But I think it's way overpriced.
Well, the interesting thing is I was looking at here is the Walmart shares gained to an all-time high this last week. The NASDAQ is actually adding it to the NASDAQ 100, which for those that like to buy your QQQ, that is going to be in the QQQ, which I don't think most people would think of Walmart as, the tech-laden QQQ type company, but, there is some optimism and hype around that, and it just seems like Walmart has so much hype behind it right now, and they're doing so many good things. I know they're working on advertising revenue, and they have a lot going on. I'm curious, too. I think they bought Vizio. I'm curious how that's going, especially in growing out that advertising business, but gosh, everything is priced for perfection, to say the least, with Walmart right now.
And I know in the past, years ago, they were known for, specializing for the lower-end consumer. I think with their website, I think they have picked up higher end consumers that don't need to go into Walmart any longer.
Yeah.
But it's just, I just can't see as a retailer. I think it's overpriced. I'll put it that way. So, all right, let's move on
Even
to.
for a tech company, it's overpriced.
Oh, yeah.
It's overpriced no matter any way you shake it.
And I like how you brought up too, and the QQQ, like the NASDAQ 100, like what? Walmart? Kind of crazy. Let's talk about Expedia. Their symbol is EXPE, then the travel services industry. I just used these today because we're looking at doing a trip down to Cabo, and I was trying to find some flight, and that's where I went to was Expedia. But 7% short on the float there. We do see the PE ratio 27.4 versus 22.4. I do remember at the time Expedia had no PE because they had no earnings. So they've kind of turned that around. But price of sales 2.7 versus 2.8. Book value very expensive, 26.1 versus 7.1. I think that's because they had probably so low amount of tangible assets. That's probably what the deal is there. Price of cash flow 10.1 versus 12.1. We do see the PEG ratio 12 versus 0.5, and that's very expensive because that's your price earnings divided by growth. You're paying a lot for the future growth on Expedia. That's not good at all. Earnings up 16% over last year, did beat the industry, down 12.5. Sales are up 5% year over year, industry up 9.3. 5-year growth rate, not so good, 2.1, says the industry is up 11.6. They do pay a dividend, very small dividend, 0.6%, using 11% of their earnings to pay that out. Taking a look at the balance sheet, current ratio on the low side, 0.7 versus 1.1. Debt to equity very high, 4.9 versus 2.2. And I have a feeling, based on what I'm seeing on the numbers, I think they have very low equity because it's just not a high equity type business. I think a lot of cash flow coming in. We do see the intangible assets also high, 30.6. Net profit margin 9.7 versus 12.4. That is okay. We do see return on equity 103.8. Yeah, this company probably has no or very little equity at all. Cash flow, a little bit disappointing. Free cash flow is about $3 billion, but the industry's up $4 billion. So I was kind of hoping to see that number higher. What do you got going for it, Jace?
Yeah, so current price here for Expedia, again, their ticker symbol EXPE. It's $285.11. 52-week range. The low here, $130.01, and the high, $303.80. We did see a little bit of a pullback in the stock this past week. Shares of travel-related names, they did get hit on Wednesday. There was a potential China crackdown. And then also, too, there's an industry group reported that 6% fewer foreign travelers visited the U.S. in 2025, while the World Travel and Tourism Council said that trend occurred even as global tourism spending actually rose in the year.
Wow.
So, the only thing I'm not sure of, and I was trying to find it, I couldn't find it quickly, was the percent of travel here in the U.S. that's done by foreigners compared to, obviously, U.S. citizens.
Yeah.
Because, as long as the volume's there, it doesn't matter if it's coming globally or internally, it's still going to be beneficial for an Expedia. And the thing I was curious on is they do actually own VRBO and some other names as well. VRBO, it's like a competitor to Airbnb.
Oh, I didn't know that. Okay.
Yeah, I've actually used them before, and it's interchangeable. It's kind of like Lyft versus Uber, pretty much the
Same thing.
same concept. But looking forward for Expedia, I was hoping for a little bit more excitement here, but unfortunately, we go out to December 2026. Estimated earnings per share $17.96. Gives a target sell price of $298.14. So not much appreciation above that current level, again about $285 a share.
And I will point out, I see 26 analysts, but the low estimate's 1549, the high is 2037, so not very tight there. However, over the last 90 days, that estimate is up from 1660 to 1796. That's an 8% increase. So they're seeing better things going forward with Expedia. And I like the company, but it's just there's no value there. There's no and I didn't look at the balance sheet because we're kind of running low on time here. But I know they have a very low equity, and what I've seen on the website that I'm trying to get flights is very good.
Yeah, I mean the thing I look at with Expedia though is kind of like our business here. You're so asset light, right? When you're at a website, you don't really have as many probably buildings. You don't have equipment. So, I mean, I don't know the ins and outs of the business per se, but I can't imagine there'd be many assets that you would hold for a company like Expedia.
And that's why I was kind of hoping for the higher free cash flow number. Thinking, gee, this can be a cash flow generator. Yeah. and that's just great, but it's not. And their dividend, what do I say their dividend was? It wasn't great.
It was pretty low, actually.
Pretty low, yeah. So if they had more free cash flow, they could pay more dividend, reinvest back in the business. But again, it's just disappointing.
Yeah, 0.5% is the dividend.
Yeah, that's just not very good. All right, let's talk about kind of switch completely from a low asset business to a high asset business.
Still kind of travel.
Yeah, travel. But we're talking about Boeing. Boeing is obviously a huge plane maker. Only really two worldwide. You got Boeing and
Airbus.
Airbus. That was the other one in Germany. I think they're in Germany. France. Gosh, France. France doesn't produce anything.
They produce airplanes.
Airplanes. Wow, that's a surprise. I thought it was Germany.
And what? Wine.
Wine.
Cheese.
Cheese, and there we go. Well, they are in the industry of aerospace and defense. Short on the float is only 2%, so that's good. 72% institutional owned. We do see no PE ratio. Price of sales 2.3 versus 3.3. Did they just report earnings? Because I'm missing a lot of numbers here. No book value, no price of cash flow, no PEG ratio. I didn't think they reported yet. I mean, we're in the first part of the year.
It doesn't look like they have.
No.
It says they'll report on the 27th.
I mean, in this company, again, we talked about this years ago. Remember when I'm pretty sure it was, didn't they take on with a new CEO like $40 billion of debt or something?
Well, that was the old new CEO, or the new old CEO. There is a new CEO that has since replaced him during.
Oh, so he's gone. I think it was Calhoun or something.
Yeah, there's Kelly Orberg is now the new CEO, and from what I've understood, obviously I think he's gotten in there, and I think he's got things going in the right direction.
Yeah, I'll take a look at the balance sheet while I look at the earnings going forward. But do see no earnings over the last 12 months. The industry is up 13.3%. Sales, now this is good, climbed 21.4 versus 0.8. Wow, the 5-year growth rate for Boeing, you're looking at 92.8%. That's well above the industry at 16.5. And that comes from the analysts. That's what they think the earnings are going to grow at per year. Boeing does not pay a dividend. I think they used to, but they're no longer paying a dividend. Balance sheet, current ratio 1.2 versus 1.6. That's okay. Debt to equity, no debt to equity. I'm pretty sure this company has no equity. Again, I'll check that when you're looking at the numbers there, Chase. Net profit margin, a negative 12.2 versus a positive 6. Return on equity, 120.1. That's very good. Free cash flow, this is not good. A negative $6.4 billion. The industry is a positive $2.2 billion. So not very thrilled with that. What do you got, Chase?
Yeah, I was going to say, I mean, the hard thing with the cash flow with this company is it's all over the place, right? When you have
Because it takes forever to get these.
Well, yeah, when you're building them, and then you could have huge cash flow if you're not building that many and delivering more planes and collecting the sales. So there's so much more of a cycle to this business that makes it very hard to analyze, in my view. I did want to kind of poke fun one more thing at the French. They also have handbags, LVMH.
Oh, there we go.
Louis Vuitton is French as well.
They're having problems, though. Those handbags ain't selling the way they used to.
But back to Boeing, this was interesting, talking about competing against the French. Boeing actually outsold Airbus in 2025 for the first time since 2018. It looks like in December, Boeing logged net orders for 174 planes, including more than 100 737 MAXs for Alaska Airlines. So it seems like, again, they're getting back on the right track. They had a few snafus, I'll call it, over the last several years with, I'm going to say, quality control. I mean, that really put a dent in Boeing and the perception people had of Boeing. But it seems like that's died out. We haven't really had many major issues. And I don't know about you, but it seems like people aren't as concerned about Boeing planes as they were a few years ago.
Yeah, I mean, they went through that terrible thing with the 747...
737 MAX.
737 MAX, and it was just, I think they had, but things happened in 3. I think they had 3 incidences.
They had a couple planes crash, and, obviously fatalities across the board. And remember, they had the door fly off mid-flight that hit social media, and I think that was a 737 MAX too.
Yeah, and I don't know if you had the price back then, but it was like really quite low, and they had a hard time. But it seems to be they got those problems fixed at this point in time.
Yeah, well, let's look at the current price here again for Boeing, $247.68. It's been on a tear here. The 52-week low, $128.88, and the high, $248.75. It looks like it did bottom out in, about 2022. Looks like when the bottom was over the last 5 years. Looks like it approached that $100 level. But going forward for Boeing, this is kind of what I'm talking about. And I don't know if I'd ever buy a Boeing because it is just so hard to understand the cycle with this business. This year, they're estimated to lose $9.60. But next year, we're looking for $2.26 worth of profit. That would give us a target sell price, again, just laughable, $37.52. Now, Boeing to me is worth way more than $37.52, but it's that cycle that's just so complicated. I mean, 2027, they're looking, again, less analysts, for like 157% growth in earnings. Could this be the uptrend finally that we're going to see in earnings for Boeing, which I'm going to say might justify the price, but given our strategy, it's just something I would never buy.
Yeah, and I thought Boeing would probably turn things around, be a good buy, but it didn't fit our strategy because we need earnings, we need cash flow, and they just didn't have that. Kind of be like a guess that they could pull through this. I did look at the debt on the balance sheet. It's currently about $44.6 billion. That was about $61 billion back in 2020. So I don't think there's anything left in this company. I think it's done.
We'll see. I mean, again, I think there might be, but we'll see.
We'll see. That's our last name. Yeah. All right. Thank you for listening to the Smart Investing Show. It is for informational purpose only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs or have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com, smartinvesting2000.com. A lot of great educational information there, and sign up for the newsletter while you're there as well. Thanks for listening. We'll be back next week right here on Smart Investing.